that China has accrued sufficient physical market liquidity to take the golden bricks gloves off. Selling gold and silver into very strong, physically held hands is what they've ended up doing. And it also did not go unnoticed that the trigger point to target these ballooning speculator positions was timed with Trump's tariff, China posturing. Wasn't it just tariffs? We were arguing about rare earths, sanctions, and one thing and another. And as we will look at shortly, in retrospect, the very short-lived Trump BRICS tantrum backfired, re-energizing the next de-dollarizing leg. Liquidity providers have assessed physically driven gold rally has simply paused mid-rally, which is what we said last time. That's all that had happened. It paused mid-rally with fresh 2026 targets being reassessed as high as $8,000.
The global gold market dynamics are undergoing a major structural transition as physical demand increasingly supersedes the influence of synthetic pricing systems. Liquidity is shifting toward regions that prioritize physical settlement and long-term reserve accumulation, revealing a disconnect between official benchmarks and fundamental supply-demand dynamics. As the dollar weakens and commodity-backed liquidity expands across emerging trade corridors, gold's strategic role is strengthening far beyond traditional safe haven behavior. Andrew Maguire, a veteran in the physical precious metals markets, emphasizes that the balance of price discovery has shifted decisively toward regions with deep physical liquidity and long-horizon monetary planning, reshaping expectations for the years ahead. This shift is allowing new settlement hubs to attract central banks, sovereign entities, and institutional hedgers seeking stable, audit-driven price formation. With physical flows increasingly favoring markets willing to absorb large tonnage at premiums above traditional benchmarks, long-term targets are being reassessed at levels far beyond previous estimates. The growing separation between paper contracts and physical bullion is enabling large players to drain underpriced supply without triggering significant price distortions, accelerating the de-dollarization trend and strengthening gold's position as a high-quality liquid asset. As physical markets tighten and synthetic shorts unwind, the broader rally appears to be pausing, not reversing, before its next significant advance. Now, we present the clips from Andrew Maguire's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Now, China has gained full control of the physically settled global gold price setting mechanism and is far better able to serve the needs of producers, institutional investors, financiers, hedgers who are attracted to being able to operate in an audibly smoothed out, stable, physically settled, high quality liquid asset supply demand environment. Now, by design, direct one-to-one convertibility of the yuan to gold and reverse is attracting these global central banks, sovereigns, and Western-facing institutional investors. Think about it. You're talking about finances. You're talking about the huge hedging business that used to belong to the cartel. And now they're able to buy and store and utilize this high-quality liquid asset physical gold within a smoothed out, physically determined supply-demand price settlement condition. And as we previously assessed, gold is collateralizing offshore facing repo markets. It's not just realized that by any of the mainstream media analysts on Bloomberg, a big chunk of the day, not a single mainstream media analyst. And they just don't get that the ability for central bank sovereigns and all categories of Western-facing global investors and these hedgers and producers to be able to treat gold as a high-quality liquid asset on their balance sheet is driving the next unfactored wave of gold demand sufficient to discover a gold price that easily doubles current estimates. Now, these SGEI hubs will also accommodate trade and storage of silver and other critical minerals and rare earths. Obviously, there's going to be a suite of them, and they'll be on site. And this unassailable mandate to back the yuan with gold stretched all the way back to 2010. I know we've looked at it before, but people are they forget. This has been in process, much like a lot of the Chinese initiatives. They are decades, centuries in play. And in this case, goes all the way back before 2010, but officially in 2010, after China opened up and encouraged citizens to invest in gold. Then more recently, they've been opening up access for smaller investors able to buy and save in gold with a click of a mouse. At every gold monetizing dedollarization stage along the way, citizens were told, it's so important, that the RMB priced investments that face them would appreciate based solely on a rising gold price. That has massive implications, especially if you're in control of all the physical reserves. Not only does this utilize gold as the perfect wealth preservation hedge into the world's largest saving rate of 43% of disposable income, people don't get that. The PBOC also steps in to take advantage of concurrent Western-induced synthetic market volatility. Beijing has smoothed out Western-diluted price volatility by way of onshore CNY price management. So if you're exposed to gold and a currency that's exchangeable to gold 1-to-1, then you're not exposed to this massive dollar volatility. And as physical market liquidity flows into China's physically settled onshore exchanges, the resulting supply-demand price exposes these deeply divergent, synthetically capped LBMA CME dilated prices as physically underpriced. It becomes clear. At times, we've evidenced the paper to physical differential at around up to 100. Sometimes it's been over $100 an ounce between the price in dollars versus the price in China, into which the PBOC has consistently arbitraged this underpriced bullion, draining it into their state-held coffers. It's a win-win situation, and it's decades in the making. We've got clear evidence that COMEX backdoor EFP supply. In other words, we've already talked about where do you get gold out of the COMEX? It's a warrant. It's until you EFP. That's the Achilles heel we've always talked about. If they didn't have that EFP in place, the whole thing would implode because you need a relationship to the big LBMA marketplace. And so what they do is they simply EFP underpriced benchmarked gold at the related diluted local London fixes. And what that's done is resulted in unreported monetary gold being drained without substantially raising the prices. That's only just beginning to be. In fact, even the World Gold Council is only just catching up with the fact that way more gold has been bought by central banks than is officially stated. And as we know, Western officially sanctioned gold price management involves creating and dumping tons of unbacked dollar price gold inside this CME LBMA ring fence. So to take advantage of these physically underpriced global fixes, Beijing has systematically sold dollar strength against foreign exchange gold to de-dollarize at an optimum level without even notably affecting the dollar price. Now, over time, it's had an effect. It flies under the radar on intraday. Now, even the bullion banks are doing it. What they're seeing is that the dollar used to be correlated 1-to-1 with gold inversely. So you've still got the automated guys that see the dollar rise, they come in and automatically sell. Not so. The bullion banks and their clients are saying dollar strength equals sell dollar to buy gold. This is a huge disconnect, not realized by so many, and again, clueless mainstream media. So this over-the-counter foreign exchange management serves really two PBOC objectives, mandates, really. So it smooths out the citizens' CNY facing price, maintaining Beijing's citizen gold price appreciation promise. But that process has also enabled the PBOC to drain Western gold to the tune of some 80,000 physical tons. We've talked about this before. There is tons of evidence to suggest that is the real number. And that's why they're taking their gloves off. They don't have to hide anything anymore. A rising gold price enables Beijing to challenge Trump and the dollar. And it's a primary reason gold's share of global reserves on a balance sheet has significantly surpassed US treasuries. And even though that's reported by the World Gold Council, it's significantly higher than they report because of monetary gold purchases. So as we enter this next 2 weeks action, we see nothing but stacker opportunities to exchange your depreciating dollars, your pounds, your euros, etc., for real money assets. Gold and silver is what we're looking at. And while we see the opportunity, there's a complete opposite in place where officials are still fighting a rising gold price. Keep it up, guys, because we're taking it. The increasingly liquid SGEI, physical gold corridor, is stealthily onboarding real money, high quality liquid asset gold assets, also coattailing exactly what the PBOC is guaranteeing its citizen, a rising gold price. The moment the yuan became one-to-one physically backed, this correlation was absolutely assured. Now, the desperate attempt to chart paint, and we've seen it, and kind of blew off on Monday. The desperate attempt to chart paint a lower weekly gold and silver close just backfired into waiting physical buyers. So basically, circling back to very, very, very short term, gold and silver are rapidly moving into strong hands with very large short stops laid above the market and naked long momentum specs rinsed and commercials one-to-one taking the long side of these freshly retrenched naked shorts. Liquidity providers have assessed the physically driven gold rally has simply paused mid-rally, which is what we said last time. That's all that had happened. It paused mid-rally with fresh 2026 targets being reassessed as high as $8,000.
The precious metals market to undergoing a decisive transition, with physical demand exerting a growing influence over global price discovery. The recent correction cleared speculative excess while consolidating positions into stronger hands, allowing deeper liquidity to form at higher structural levels. Gold and silver are repeatedly finding support at key thresholds, signaling that physical buyers, including institutional and sovereign participants, now dominate the order flow. Attempts to pressure pricing through synthetic market activity are becoming less effective as physical exchanges absorb metal at premiums that accurately reflect actual supply and demand conditions. This shift is reinforcing a multi-year trend in which momentum traders are being displaced by long-horizon accumulators who respond to physical signals rather than leveraged positioning. Silver's strong bid zone near primary psychological levels and gold's resilient base at progressively higher levels reflect the growing importance of real inventory, forward delivery commitments, and global diversification away from currency-linked assets. As physical liquidity continues moving toward markets that prioritize transparent settlement and long-term storage, synthetic pricing structures are increasingly exposed to short squeezes and forced covering. These dynamics point toward a broader recalibration in which underlying value is determined by actual bullion flows rather than speculative leverage, setting the stage for stronger moves as the cycle unfolds. Let's get back to the interview.
We have just witnessed the largest ever transfer of gold and silver wealth from weak hands into strong at a substantially higher physically supported rally stairstep. So while the 10% top to bottom correction has cleaned out all the froth and has now wrong-footed these same leveraged actors to flip from naked long to naked short, bless them, selling gold and silver into very strong physically held hands is what they've ended up doing. And it also did not go unnoticed that the trigger point to target these ballooning speculator positions was timed with Trump's tariff, China posturing. Wasn't it just tariffs? We were arguing about rare earths, sanctions, and one thing and another. And as we will look at shortly, in retrospect, the very short-lived Trump BRICS tantrum backfired, re-energizing the next de-dollarizing leg. So let's start by reviewing the short-term footprints and really to identify where the largest institutional size spot gold and silver buyers are taking the long side of these naked short momentum traders who are still in there, and how this translates into where these physical orders are aggregating right now. Actually, from a paper to physical perspective, it's pretty straightforward, really. But let's start with silver. So in silver, the very strong SGEI, the international facing SGE exchange, the physically determined support that we reported last time was at spot $48, and this was around here. And it indicated synthetically driven dips below this physical support level were nothing but an opportunity to convert underpriced synthetic silver into bullion. Bearing in mind, we'd just been through a 10% correction, and we were picked up our recording at this point here in our last episode. Now, I'm again recording this. I always wait for between the AM and the PM fix, and usually at around about the pit open, because at the pit open, we do tend to get selling events coming in. But I think they're getting run over, and we wouldn't count them completely out yet, but it's getting very close to a breakout. Now, because silver has been backwardated significantly, I mean, we talked about $3 spreads at one point, that is $10,000 per contract. Apologies, $15,000 per contract differences. And we'll look at how that is settling down and really what that means. But essentially, because there was a difference where we show, this is the futures chart, so where we show 47.90 was in fact the 48 spot level. So we had to make those adjustments on the futures charts. Now, if you're a soulless futures trader, you're not going to be aware of the fact that spot silver was already above 48. And this is where institutional, very strong institutional buying was occurring. Now, this window of opportunity to buy physical silver at or below $50, and $50 is $49.90 in futures. So any opportunity to buy silver below that price is very, very short-lived if there are any more pullbacks. So as a result, leasing silver from SLV, etc., to sell into the market to cap prices is drying up. In fact, with Loco London largely pushing on a string to short cover, and underpriced SLV is actually being cashed in to meet significantly higher SGEI determined physical delivery benchmarks, these bets will have to be short covered at a big loss. In gold, continued official efforts to try and cap spot gold at 4,000, which actually just happens to be 4,350 in futures, also backfired on Monday. Very strong central bank, sovereign, and institutional demand has been taking everything on offer at around 4,000, and they now raised their bids to 4,100, which happens to be a spot, which happens to be 4,105 futures. Now, given there is strong options demand and short stops at and above 4,100, it was no surprise to see these vulnerable shorts getting attacked on the way up. Now, much like we looked at in silver, these very same actors have short stops above 41.75 in gold. And if you remember in silver, it was at 51.83. So moving back to gold futures, that's where the stops are. Now, is it any coincidence that we are seeing Asian buying physical, West selling paper, pit open, sell, pit open, sell, pit open, sell, pit open, sell. We've just had the pit open again. It is running out of steam. Why? Because the physical markets are underpinning this move. And just like we evidenced at 3,900, 4,000, we're now seeing very, very, very strong, seeing dips below 4,100 now being attacked, i.e. attracting central bank sovereign and institutional buy interest. Now, liquidity providers assess similarly imbalanced GLD ETF shorts would be forced to be repaid well above 4,000, and that is significantly offside. So following the CTA hands getting flushed out, that was the speculative, the non-sticky CTAs, the speculators getting flushed out of the gold ETFs, and good riddance, very sticky institutional ETF demand is also returning, forcing GLD short covering. Now, just to understand what was being attempted by the cartel, was a second weekly close. Now, we had a weekly close below the prior week's week. Then last week, this was they attempted one more time to get a second weekly close lower, and they failed. And they failed because everyone at $4,000 were a buyer. So following 3 weeks of pretty much sideways action, officially capped footprints, all official capping efforts to close gold below 4,000 into that weekly close failed, and it's backfired, serving to coil gold for a larger rebound from deeply oversold conditions here. And what it's done is, as we drew this in last time, this has established the next in a higher series of footprints, physically supported footprints. Real money has only just commenced seeking exposure to gold. This fresh demand alone is anticipated to drive a physical end-of-year price to 4,500 at a minimum.
The precious metals market is entering another decisive phase as physical demand continues to outmuscle speculative volatility. Recent price swings, although sharp, have revealed a more profound structural shift. Gold and silver consistently attract strong bids on every dip, indicating that long-term buyers view current levels as strategic points for accumulation. Physical exchanges are increasingly setting the pace, absorbing supply even when synthetic markets attempt short-term pressure. The broader trend reflects a global shift toward assets that offer liquidity, stability, and protection during periods of monetary turbulence. With currency dilution accelerating and traditional safe havens losing credibility, investors are positioning ahead of what appears to be the next sustained leg higher in precious metals. Silver's firm support near significant thresholds and gold's stability above each new structural floor underline how real flows, not speculative leverage, are now defining market behavior. This transition is reinforcing the narrative that physical metal, rather than synthetic exposure, is driving price discovery across global markets. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.